Hey, welcome back, options traders, and happy Friday to everyone. And I was speaking to a trader here recently who had a really good question and was asking, is it a danger to hold an option close to expiration? And his situation was he had purchased an option maybe with 9 months to expiration, and now he's getting to, let's say, within a 60-day window. And he says, well, I just don't feel comfortable with so little time. Should I roll it out? Or should I just continue to hold my 60-day option and roll it out then? It's a super question. It's one of my favorite topics because there seems like there's a very obvious answer, and you're going to find out it's not so obvious. And that's why it pays to understand how options work. So let's go find out, is it a danger to hold an option close to expiration? And before we do, please be sure to click like and subscribe. Always appreciated and helps so much to promote the channel. So once again, here's the question. Here's the dilemma. Let's say that you buy a $100 call, maybe with a year till expiration. And now it's dwindled down. Maybe it's got 60 days or 30 days. Pick a number, doesn't matter. But we're getting close to expiration. And the thing is that traders feel safer when they have more time. And so the question is, should you roll out? Is that really going to be a benefit? Well, the first thing to understand is that you're just dividing up a portion of a year. You're just dividing up a calendar. And so in that sense, it doesn't make a bit of difference. So let's say that you have 60 days until expiration, and you want to switch to one that has 360 days to expiration, which was the amount of time that you initially had. Well, what's the difference if you hold for another 60 days and then roll to this option, which by then would have 300 days? But notice that regardless of your choice, it's still a 360-day window. So from that sense, it hasn't really changed anything. And we can see this from the two risk graphs. Here is a 60-day till expiration option, and here is 360 days. So these are the current curves. And notice that if we stay on the current curve with 60 days in blue, that if the stock drops, we're better off because the blue sits above the red. And if the stock price rises, we're better off because, again, the blue always sits above the red. And so part of the reason for this is that if the stock price falls, you have less money into the position. If you roll out, you're going to have to spend money. It's a debit trade. And so that's what's going to cause you to put more money into the trade. And if that now goes against you, well, you've got more money to lose. But if the stock price rises, you've got higher deltas because shorter dated options that are in the money are going to have higher deltas. There's a higher probability for them to expire in the money. So the market starts pushing those deltas higher. Now you can see, at least when we compared these trades, with 60 days to expiration versus 360, there really is no difference here in the center. But as time passes, let's say 60 days later, you're going to switch from these risk profiles to this. See, now you can see that the 60-day option does dip below which is now a 300-day till expiration option. And this is where traders say, see, I'm better off here in the middle. I'm not going to decay as much. And they're completely overlooking the fact, again, that if the stock price falls, they've got more money into it. And if the stock price rises, they're not going to be as profitable. But this is really just an illusion. The reason that this red curve sits above the blue for this area here at expiration of the 60-day option is because you paid for it. It's just a reflection of the extrinsic value that you purchased. So it's not necessarily a benefit that came for nothing. You had to pay for this to get above here. But again, remember, there's a very big cost. If the stock goes against you, you've got more to lose. And if the stock rises, you're not going to be as profitable. So as a trader, the real question that you have to address, how will more time affect the behavior of the strategy? So for example, rolling out in time will increase your vega. Is there a reason that you want increased vega? It will increase the deltas for an out-of-the-money option. Maybe your option has fallen out of the money, you're still bullish on the underlying, but you'd like to get those deltas up. Okay, that might be a legitimate reason for rolling the option out early, but not because you're trying to avoid time decay. You're also going to decrease your gamma. Maybe there's a reason you want to get away from high gamma. But once again, these are the questions that you have to ask. It shouldn't be, oh, I'm afraid of holding a short-term option, so therefore let me roll out. Because that's not really a reason for rolling out early. Now, we've talked about this before, but here's another more detailed reason why it doesn't pay to roll out early just for the sake of trying to avoid time decay. So let's see if that can actually be done. Let's say that you buy an at-the-money 30-day $100 call according to a pricing model is worth $229. And after 15 days, the halfway point, time decay will begin to accelerate. I think most traders know that the steeper part of that time decay curve is in the second half of that option's life, assuming it's an at-the-money option. So what traders might do is they'll say, okay, I'm afraid of getting into this second half of the option's life where that time decay is going to accelerate. So let me sell what is now a 15-day option to close, and I'm going to buy a 30-day call to open. So instead of riding into that second 15-day window, let me roll it out. So I always stay up on this slower part of the time decay curve. So for example, here's a time decay curve. Again, our pricing model shows that the option's worth $229 with 30 days to go. As time goes by, the option's price starts to lose value. And over here, we can see it really going off the steep part of the time decay curve. Here's the halfway point. Pricing model shows it'll be worth $1.62. So let's say that you buy this option for $229, and at the halfway point, you're going, gee, I don't want to ride into this heavily decaying part of the option curve. So let me roll it out. And what I can do is I can close this option and collect $1.62, and I can buy another 30-day option for $229. That's going to cost me a net 67 cents. So by spending 67 cents, I'm going to avoid losing $1.62. And traders say, gee, it's a no-brainer. Why not do it? Why not always roll out and stay up into this portion of the time decay curve? Well, again, this is just an illusion. Let's compare two traders. Let's look at trader A and trader B. Now, here are actual prices from a pricing model. Here's our 30-day option worth $229. After 15 days, it's worth $1.62. Trader A buys the 30-day option, spends $229, and he rides it all the way to expiration, and we're just going to assume that the stock price doesn't move, so he loses the full $229. Trader B, on the other hand, says, I'm not going to ride into that second part of that time decay curve. So he spends $229, and at the halfway point after 15 days, he rolls it. So this is what we just looked at. He's going to collect $1.62. He's going to have to spend another $229 to buy a new 30-day option, so he has to spend 67 cents. But notice that in total, he spent $229. He has now spent another 67 cents. He has $296 total into the position. So after 15 days, he can close it again for $1.62. And so from his perspective, he says, hey, wait a minute. I put $296 into it, but I got $1.62 out of it. So I'm only down $1.34. And if I compare it to trader A over here, I am better off by 95 cents. So this seems to be the big motivation for traders to roll early. But take a look at what's going on. What is this roll right here? If you buy a longer dated option, that's the 30-day option up here for $229, and you sell your current option for $1.62, that is a calendar spread. All you've done is you've put a calendar spread on top of the original option. So for example, let's go back to our time decay curve. So remember, this was 30 days till expiration. We were looking at all of the option prices as time passes. So you bought this 30-day option worth $229, and after 15 days have passed, that option's worth $1.62, all else being equal, and that's where you decide to roll it. So if you spent $229 and now sell this option for $1.62, that is the cost of the roll. That's where that 67 cents is coming from that we saw on the previous screen. However, also notice what you've done is you have purchased an option for $2.29 and you have sold an option for $1.62. Now, yes, granted it was selling to close, but don't let that throw you. You sold an option for $1.62. In this case, it was to avoid a $1.62 loss. But if you ride this all the way for the next 15 days and the stock price remains the same, you are going to collect $1.62. Now remember, again, it's more avoiding the loss. That was the reason for the roll. But mathematically, you have sold this option for $1.62. If you can close it for zero at expiration, that would be $1.62 gain. So look what happened. You spent 67 cents on the roll. You've avoided the loss of $1.62. And what is that? That's a 95-cent profit. Where is it coming from? Well, it's coming from the fact that the shorter term option decays faster than the longer term option. Again, it's just a calendar spread. So if we let that 95 cents decay right there, that becomes your profit. And that is exactly where you will end up on this time decay curve. That's where that 95-cent profit is coming from on the previous screen. But now, let's dive a little deeper. Why 95 cents? Why not something different? Well, the 95-cent profit relative to the 67-cent cost is a gain of 41%, or 1.41 times. And we've talked about this before in previous videos, that option prices are proportional to the square root of time. Well, now instead of looking at the option prices, let's look at it in terms of time. And that means we need to square this number. So 1.41 squared is exactly 2. And the reason it's exactly 2 is because the option that you own has twice as much time as the option that you sold. There's nothing magical about moving to this upper part of the time decay curve. You didn't really avoid this. All you did was buy a calendar spread. You put 67 cents into a new trade hoping for a 95-cent gain. And it gives you the illusion, the misperception, that it was just reducing your time decay. Here's the calendar spread right there. There's your max gain of 95 cents. There's the cost of 67 cents. You're paying 67 cents, that was the roll, for a gain of 95 cents. That's why it looked like it was reducing your losses by 95 cents. But traders don't see this as buying a calendar spread, and here's why. Let's say that you buy the January 100 call, maybe it's got 30 days to expiration. After 15 days, you decide to roll it. So you close that January 100. And then you buy a new 30-day option, maybe the February 100. But notice that these two trades on the right make up a calendar spread. You're long a longer dated option, short a shorter dated one with the same strikes. But the reason that traders don't see this calendar spread is because it simply closed this short call right here. So they just see that they're long the Feb 100 and they feel that they have done something great and wonderful because they have now avoided this 95-cent potential loss, when really all they did was buy a calendar spread. Ultimately, all they've done is swapped negative theta for positive theta by buying a calendar spread. So this whole idea of rolling out to avoid time decay is really a misperception. You are buying a longer dated call, but you're also selling a shorter dated call. Now again, just because this is selling to close, people forget about it. But remember, we've talked about that in previous videos. Forget about this whole idea of opening and closing. You're long a longer dated option, that's the one you've rolled out to, and you've closed a shorter dated one. You have purchased a calendar spread. And in this example, you were paying 67 cents to make 95 cents. That's where that apparent avoidance of time decay is coming from. It's really the potential profit from the calendar spread. So the whole point of this is that you shouldn't roll out just because you're fearful of being on the shorter end of that time decay curve, or just because, hey, I had a 1 year option and now it's a 60-day option and I'm fearful of it. Let me roll it out early. Those are bad decisions. Instead, what you need to ask, is the calendar spread a good trade? And of course, that requires a whole different discussion. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.